Well, let's take a look at how the markets closed. You have your closing bell there. So as we see there, all three major indices ending in positive territory. Not as strong of a rally as yesterday, but still in positive territory. The Dow there relatively flat, though, up 51 points. The S&P 500 up about 2/3%. And the tech-heavy Nasdaq, the biggest gainer of the day, up 1.58%. Well, let's bring in our market panel to digest all the market action. We have William Huston, Bay Street Capital Holdings Chief Investment Officer, and Jay Hatfield, Infrastructure Capital Advisors CEO. Good to have you both. So first, I want to start with Jay. What are you watching in terms of what we should read into this rally and how long you think it might last?
Thanks, Michelle, for having me on. We had been optimistic about going into the earnings season. We think the U.S. economy is relatively strong and definitely stronger than most people appreciate. So we've been optimistic about earnings. And also, even if earnings are somewhat mixed, maybe some tech stocks will be challenged because of foreign currency and maybe weak demand in Europe. It's still an opportunity for companies to control the dialogue. What happens in June is there's very little information from the companies. It's kind of hedge funds gone wild. A lot of short activity, but without any information. When there's earnings, then there's winners and losers. So usually short sellers will lighten up their shorts. It pays to be long, so people add to their positions going into earnings. So it's kind of a normal seasonal pattern where the market rallies through earnings season.
William, there's been some debate about whether or not we've seen capitulation, if the markets in fact have bottomed and we're starting to see this upward movement. Where do you stand on that?
So yeah, in terms of capitulation and how demand is being affected, I think this earnings season is something that we've not seen in recent history. My counterpart mentioned the word optimism. I think we're trying to, as investors, determine, I want to be optimistic, but I want measured optimism. From a leadership team standpoint, there are some leadership teams that I personally think have been too optimistic going into the environment that we're in. And investors should be looking at companies that, from a net margin standpoint, that we're experiencing COVID-related net margins. The market that I've been watching has really been pricing in the drawdown that we've seen. If you were to overlay net margin and then bring that back down to a normalized return, you'll see that companies are actually starting to trade closer to where net margins were historically. And so that's how I would be thinking as an investor, as I'm looking from a macro view, what's going on in the market and why are some of these companies moving the way that they are.
Yeah, and Jay, we've had the big banks report. Today's a big day with United and with Tesla. And then the rest of the week, we still have American and Snap and Twitter and Verizon. Is there thematically something you're seeing or expect to see develop over the next couple of days in earnings?
Well, we're expecting that companies that have more of a domestic focus, so you already have seen it, regional banks, REITs, pipelines and MLPs are probably going to do extremely well. Keep in mind, and very few people focus on this, Europe's problems, unfortunately for them, are our opportunities. So we have an 80% cost advantage over Europe on electricity and natural gas. So any heavy industry, chemical companies, metals, obviously energy and natural gas, they're likely to have a very, very strong earnings. And I think tech will be mixed, although I will say that expectations are quite low. I would attribute today's rally to a relief that Netflix didn't blow up. So you saw tech and some other risk categories rally. So I think tech might be mixed depending on the expectations going into the quarter.
So William, in this rate rising environment, what is the strategy here? How do you, because a lot of, some of our analysts have said, look, hold on to your cash. This isn't the right time yet. What's your take on whether it's time to hold into your cash or some of the opportunities that you see?
Sure. So every investor is going to have to make sure that they're following their investment thesis. You know, at Bay Street, we have had the majority of our clients in at least 20% cash since January. And as the market has continued to draw down, what we want to make sure is that we're not impulsively jumping in because we think that there's some sort of bottom that we can predict. More what we're looking for, as we know that rates are going to continue to rise, we know that prices are continuing to rise, especially in the real estate space. We're really looking for opportunity in alternative asset classes where there are things like a motivated seller or properties that are priced appropriately. last month we saw 88% of new homes that were sold that actually made it from start to finish. They were on the market for less than 30 days, right? So although we've seen a slowdown in terms of total homes that are being purchased, we still see homes that are appropriately priced are being picked up, and 25% of all of those homes were purchased by cash buyers. So what that's telling me as an investor, if I'm looking for something as it pertains to an investment and I'm looking at my whole portfolio, the real estate space is still attractive for somebody who's had cash on the side and they're looking to make sure that their portfolio is not going to be super volatile during this earnings season.
Jay, what do you think about the cooling that we've seen in the housing market? Some concern there about what that could mean for economic growth going forward. How is the market looking at that, and what do you anticipate that we'll see in the short term at least?
Well, that is the critical sector to really focus on. That's what normally cracks when the Fed is raising rates. So housing usually will go into really a huge tailspin, and that really leads us into a recession. And also it's worth looking at autos as well. But we think that people are misinterpreting the data. There's a huge shortage of homes. And in fact, right now, there's only about 1.3 million homes for sale, which is seasonally adjusted and all-time low. So you have to be careful when data like existing home sales come out to correct for the fact there isn't a lot of inventory. Now, we by no means think that the housing sector isn't going to cool off, but we're not going to have a crash like we did, obviously, in 07, 08, where we had, instead of having 3 million shortage of homes, which we have now, we had 4.5 million extra homes. So we think that's going to make the U.S. economy very resilient, particularly compared to Europe, which is suffering from an energy crisis. We think they will go into a recession and cool global inflation, because Europe's recession, again, would benefit the U.S. because be less demand for goods overseas.
And let's follow up on that likelihood of a recession in Europe regarding Nord Stream. Jay, what do you think, William, what do you think is going to happen there? Do you think they'll fall into recession?
It's possible. I think that it's hard to, predict exactly what's going to happen. I actually agree with everything that Jay just said in terms of how I'm looking at it from a big picture standpoint. There's actually a lot of demand, just as he spoke to, on Americans that are looking at opportunities in Europe. The amount of Americans that are purchasing homes overseas is 2.5, 3 times higher than it was a couple of years ago. And all of that happened, again, in a very short period of time. So as the U.S. has seen rates rise extremely fast, what opportunistic buyers are doing is they're saying, look, if the average home costs $400,000 or $500K here, and I can buy something that's larger from an investment standpoint in a European country where there's going to be a strong demand for travel, or just for me to be able to own an investment property at a better price point, that's how I'll be looking. Like, again, I wouldn't say whether or not it's going to lead to them for a recession. I do think the energy issue is meaningful. I do think it's very likely that there will be a slowdown, but we'll need to wait and see.
All right, William and Jay, I want you guys to hold on because we have some breaking news out. Tesla has its earnings, just releasing its earnings. Pras Subramanian has that for us. Pras.
Hey there, Shauna. So yeah, the stock bounced around a bit here, up after hours. They reported a slight revenue beat of $16.9 billion versus the $16.88 expected. Big bottom line beat here. Q2 adjusted EPS of $2.27 a share versus $1.83 a share. So beat on the top and bottom line here. Free cash flow around $621 million, so less than last quarter, but still positive here. They note that Berlin hit a milestone of 1,000 cars produced in 1 week, so that's a big thing for them in terms of the ramp up of that Berlin Gigafactory. They're also maintaining their 50% CAGR growth rate or compound annual growth rate of 50%, which means they'll probably produce around 1.4 to 1.5 million vehicles in 2022. That's actually a kind of reiterating that forecast. So a lot of very positive note there for investors. They've also converted some of their crypto to fiat. Around 75% of crypto converted to fiat, so they're noting that balance sheet change there. Also, just going to watch, for the call, we're going to watch on more on the ramp up in Giga Berlin, Giga Austin. Want to hear more about the China factory, Shanghai factory, how that ramp up's going back. Are they back to normal? And also any supply chain issues, any production issues from that point of view. So I'm going to keep looking at this release here, but back over to you, Shauna.
Thanks so much, Prasad. That forecast here in terms of vehicle deliveries, I think is a big reason why we're seeing shares pop. Like you said, up just about 4% after hours. They still expect to see 50% average annual growth in vehicle deliveries. We have Dan Ives of Wedbush coming on later in the show. That was the key thing that he was focusing on in this report, was the guidance for the second half of the year when it comes to deliveries, when it comes to production. When we also want to talk about some of the, I guess, what we could look to in the future here for Tesla, they expect to further increase Shanghai production rate, which obviously is good news here for the company. They did, though, say that they saw a continuation of manufacturing challenges on shutdowns during the latest quarter, something that we were expecting given the Shanghai lockdowns that obviously impacted the company. But Rachelle, looking at this report, it's pretty good here just in terms of what the street was expecting, in line when it comes to revenue, and a beat on adjusted earnings per share, $2.27. The street was looking for $1.83.
And we know that Elon Musk had previously referenced some of these high startup costs for some of these newer manufacturing hubs. So we knew that that was going to take issue there. We know that that was going to come up. But I think this is much better than the street was expecting. I think this does put Tesla in a very strong position. A lot of people wondering how much Tesla would be impacted by those shutdowns in Shanghai. Obviously, we'll hear more in the guidance that comes along with it. But I think this is a very strong earnings report for Tesla.
Tesla grows 42% on the revenue, but margins decline. Let's bring in our panel. William Huston back with a comment on those Tesla earnings. William, what do you see? What's your headline?
Yeah, so I'm fortunate. I live less than a mile away from the Fremont Tesla factory. And, you know, for us, we can actually see how these trucks are being delivered. And I think Tesla is really good at surprising the market. I think a lot of the estimates, they're kind of softball pitches. I'm shocked by the EP, the earnings per share, but I think, again, the narrative that we had where they were scaling back on some of their staff, that was going to increase net income overall. The China slowdown, I think, is an issue, like you said, and the supply chain is an issue there. We knew they were going to deliver less cars than before, but I am curious to see just like where that earnings per share actually came from. Was it just a shift in the balance sheet, or was it an effect of the release of a small percentage, like 3% of their total staff came down? So that's what I'm going to say we're looking at overall. But I think Tesla, they're really dominating the EV space in terms of percentage of new vehicles that are purchased relative to their peer group.
All right, William Huston, Jay Hatfield, thanks so much for joining us.